Are you that type of a trader who becomes paralyzed when you want to make an entry trigger? Of course, you've analyzed the markets, you've actually marked your point of market interest, but when it comes to the time when you are about to enter the market, you actually get paralyzed. You understand your trading strategy very well, or you've been actually taught a very powerful entry criteria, but whenever you come to the point of entering the market, you become paralyzed. Or basically, you are late to the party, or sometimes you are very early to the party such that you are trapped by the market and you find yourself losing money each and every time you try to trade. In this particular video, I'm going to show you 3 entry confirmation techniques that will definitely help you remove that paralysis whenever you want to make an entry trigger. All that you need to do is to watch the whole video from start up to the end so that you fully comprehend everything that I'll actually share with you. Without further ado, let's jump right into the lecture. Alright, so we all know that money is made when we open a buy or a sell entry. We always know that to make money in Forex, we need to risk something. However, after analyzing the market, you've done your chart markup, you've drawn your trend lines, you've drawn your supply and demand. No matter whatever strategy that you use, most traders find it difficult to get the exact point of market entry. As mentioned earlier, we are going to look at 3 most powerful trade entry confirmations. I'll assume that you already have a strategy that can provide you with market point of market interest. This is because we'll be focusing on what to look for at the exact point of entry trigger. So let's jump right in. Firstly, the first step in any trading strategy is analysis. We say if you do not analyze, you lose focus, and when you lose focus, you enter recklessly. In my opinion, I use the institutional market maker method, where I count levels as well as determining the market maker trend. Institutional market maker method is the only trading strategy or trading methodology that I've seen much more efficient than a lot of trading methods out there. Other traders use trend lines, fair value gaps. Like right now, there is a lot that is being talked about on fair value gaps, or basically they use the basic default indicators. Whatever you use, make sure you have a method of analyzing and obtaining the market trend so that you can do the next step. So the next step is basically to obtain what we call the point of market interest. It is the point where we want to take action when the market checks in that particular point. So I've just used my point of market interest from the market maker method, which are 1, the peak formation high or low point of interest. So whenever we say peak formation high or low, it's basically a point of reversal. And when we are reversing, we either look for M or W pattern, or basically an inverted or a head and shoulders pattern. So in this scenario, I've drawn, this is the first leg of the market structure. And the first leg of the market structure is the point where I derive my point of market interest, waiting for the market to actually come back to that particular point. When it comes back to this zone that I've marked in green, this is where I call the point of market interest. So this is the market interest for this particular type of point of type of POI. Then the other one is the trend trade, whereby I use several indicators. And if you've been following this channel, you know the indicators that I use. Some of the trend trades come in this manner, whereby the market is actually going, and when it reaches the EMA of interest, that is where I have my point of market interest, like in this particular case. So this is an example of a point of market interest. Then the other one is the zone of market interest, which is another point I expect to get an entry confirmation. So in that instance, it's actually derived from the zone of market interest, which is derived from a previous cycle into the new current cycle. When the market pulls back to that particular point, I expect to find an entry confirmation like what is being shown here. So these points are the points that I call points of market interest. They are only determined when you've made your market analysis. So after that, you've analyzed the market and you've determined a point of market interest, the next thing is now to make an entry after excuse me, after confirming with these three confirmations that I'll give you. Entry confirmation 1, I call it the shift candle retracement. So this type of entry confirmation works perfectly on points of interest that consist of supply or demand, like the peak formation low or high, POI, that I showed you just earlier. So when we get a supply, like in this case, we have a supply and the market comes to that particular point and we are expecting to see a retest of that supply. This is where the shift candle retracement comes into play. It is an entry confirmation whereby you are waiting to short the market at this particular point, and the market give you a very fast moving candlestick to the downside, which if you enter at its close, you are definitely going to have a very big stop loss. So sometimes the market reaches the zone of interest and it will shift more than 50 pips in one particular candle. If we have a very big candle in a day, or the biggest candle in a day, we call it a shift candle. So we were mandated that we must only enter the market at closed candles so that we won't be trapped by the market. But entering at such shift candles will widen our stop loss. So if you enter, probably there was news and there was a spike. And if you enter at the end of that spike, you are likely going to have a very wide stop loss. So what do? This will now require us to wait for that candle to close. Wait for it to close and then set your pending order at 60% of the shift candle as shown below. So we are saying 60% of that particular candlestick is where you will set your pending order. It might be a buy stop, a sell stop, a sell limit, depending on whatever scenario that you have. So in this case, we had a drop of the market, right? After dropping, we had the first leg. This first leg determined this point of interest. I drew this particular rectangle in white, and then the market went to the upside. What I wanted was to create a W pattern because this was a peak formation low. The market came to the point of interest, but what happened is there was this red candle, then this green candle, which is the candle that I'm waiting to enter a buy, was issued as a shift on the H1 time frame, giving me if I am to enter at its close, it means my stop loss is going to be wide. Why? Because the entry is going to be here and then my stop loss below structure is going to be wide. So that is where I have implied to enter only at 60% of the shift candle. So you put a buy pending order here at 60%. We can see this is 100% of that particular candle, and at 60%, that is where we will put our buy pending order. Then the market actually came to tap that 60%. So sometimes it will come to 50%, sometimes to 60%. So it will be better to be at 60 so that our stop loss below structure will be much more smaller. So that is the first entry confirmation technique that you can do whenever there is this particular scenario. Entry confirmation 2 is the engulfing pattern, which is basically use of candlestick reversal patterns. And this type of entry works on all type of points of market interest. It might be the peak formation high low, or the trend trade, or the point of market zone of market interest, or it might be a trend line that you use, or it might be at the fair value gap that you use. Any type of strategy that you use, this particular entry confirmation will work. There are thousands of candlestick reversal patterns, but the ones that works effectively are the engulfing patterns. I understand there's the morning star, there's the hammer, there's a lot of stuff that are out there, but in my research and my experience, the engulfing pattern is the one that is worth to follow. So these are the bullish or bearish engulfing patterns, and entry must be done only at candle close of the engulfing pattern. So we are saying the sequence will be: wait for the market to check in your point of interest. You've already analyzed, you've already determined the point of interest. Now you wait for the market to check in your point of interest and see a bullish or bearish engulfing pattern. So when that engulfing pattern closes, it's time to enter. So you enter after the engulfing pattern closes, as shown below. So in this case, there were these point of market interest, and this one, another point of market interest, and all of them were derived from the third one that I illustrated earlier before, the zone of market interest. So in this particular case, the market tapped that or checked in the point of interest, and after checking in, we can see there's this green body which is within the red body of this candle. So this candle, we call it engulfing this particular candlestick. So at the closure of the engulfing candle, that is where we will have a confirmed entry. We can see another one here. There was this red candle being engulfed by this green candle, and at the close of this particular point, that is where we will actually make a confirmed entry. Of course, this was not long-lived. It is just there. I just put it for illustration's sake so that we may understand clearly how to use the engulfing pattern. Then the last but not least, which is the easiest of them all, I call it the 13 EMA cross and close. The 13 EMA cross and close is for those who do not want problems, those who do not want to crack their minds or to have subjectivity activity. This type of entry confirmation works on all types of points of market interest. It might be the ones that have a trend line. It might any type of entry confirmation. You can use the 13 EMA cross and close. However, we will require EMAs, particularly the 13 EMA, and we'll observe the market and let it reach and tap into our point of interest. If you've seen in each and every type of entry confirmation, I am emphasizing 1, analysis, 2, determining the point of interest, and then 3 is when to wait for the market to tap in that particular point of interest and then enter after these confirmations have been done. So it is the simplest entry confirmation as we would trigger at the candle close above or below the 13 EMA, depending on the market context, of course, as shown below. So here we can see that we had this rainbow of EMAs, and the market is actually going to the upside. All that we wanted was to see a pattern on the lowest EMA, which is this particular point. Then this touch was the first touch, and then we wanted to get the second touch, meaning this particular point was going to give us the point of market interest. After that, we can see the market creating a W pattern, and when it tapped the point of market interest using the 13 EMA cross and close, this green candle did so, right? We can see this candle crossing to the above point, and then after crossing, we can actually make an entry at candle closure of this particular time frame. So if we are to apply everything that we've learned, we can see that this green candle is a shift candle. We can actually set a pending at 60%. We can as well see that this green candle is an engulfing candle, meaning this is a bullish engulfing pattern. So you can see that these 3 candlestick entry confirmation techniques can be actually summed up to become one thing, and that one thing will have several confluences for you to make an entry. On that note, we've come to the end of this video. Thank you for watching. Like and subscribe, and join our free Telegram, our free Signals Telegram channel. I'll leave the link in the description box below. See you in the next one.